Good evening, everyone, and a warm welcome to our post-earnings conference call for the quarter and half year ended September 30th, 2018. I have with me on call Mr. Vijay Kumar, our CFO, and Stellar IR Advisors, our Investor Relations Advisor. We hope that you all have received our Q2 FY19 investor presentation and gone through the same. We have also uploaded it on the stock exchanges for your reference. We will begin the call by sharing key updates on our business, industry, followed by a summary of our operational and financial performance, post which we could open the floor for question and answer session. First and foremost, on our new project, the civil construction work which got delayed due to the inclement weather is now moving on track, and we expect to complete major works by the end of Q3 FY19 or calendar year in 2018. The current work status is as follows. Construction of the cold storage building has been completed. The civil work of the processing building is in progress, while the prefabricated structures are nearing completion. Some of the equipment like cold storage units, ice makers, etc. are being installed. The machinery room is also close to completion, and the work pertaining to the power lines has commenced. Dormitories for workers and other staff members is under construction. Overall, we expect and are looking forward to start the trial production sometime in the last quarter of the current financial year, that is Q4 FY19. We expect the full capacity of 20,000 metric tons from this new plant to be fully available for the entire fiscal year FY20. As for the capex incurred of the total plant outlay of almost rupees 90 crores, rupees 62.5 crores has been incurred as of 30th September 2018. Now on our existing business front, we would like to highlight that when compared with last year, the past quarter and H1 of the current fiscal has been a little lower. This is on account of two key reasons. The incremental festive sales, especially to the US, which falls typically in the Q2 and partially in Q3 of fiscal year, were lower than expected on the account of utilization of most of the piled up inventory in the warehouses, and also shortage of certain sizes during the last quarter had made an impact on the volumes which could be produced. Lastly, as a conscious strategy, we remain selective in executing orders which met our pricing and profitability threshold. Nonetheless, we have been able to largely maintain our volumes sold at 7,368 metric tons in first half of FY19 as against 7,598 metric tons in the same period of last year. Consequently, and also on account of our integrated model and favorably diversifying revenue mix, we were able to maintain our profit margins too. Further in line with our aim to diversify geographically, the share of European Union in the overall revenue mix increased to 25% during the first half of FY19 from 18% in the entire year of FY17, despite the strict quality norms and checks placed by the European Union authorities on Indian processors. We aim to better the mix further in the coming years. Going ahead, our upcoming facility will enable us to add new products like ready-to-eat category, which will cater the demand for such products in our existing as well as the new markets that we plan to foray into. Lastly, given the current demand, supply and pricing scenario, along with our growth strategies in place, as of now, we continue to look forward to reaching a revenue mark of rupees 1,400 crores by FY20. However, we request you to note this as only an estimate, and we may provide you with a more realistic guidance towards the beginning of next fiscal, in line with the expected industry or business environment for the next year. Now coming on to the industry updates, we had mentioned in the last quarter's conference call about the shrimp prices, which hit the recent bottom in March and April of 2018, had started to inch up and is stabilizing at current levels. Similarly, farm gate prices have improved and the farmers have stocked seeds for the winter crop, for which the harvests are taking place and would continue to take place over the next few months. We expect the business to normalize given the number of promotions being taken up by our end customers both in retail and the food service segments. Now, our CFO, Mr. Vijay Kumar, will explain the financial performance of the quarter and the half year ended September 2018.
Hello, good evening everybody. I am here by presenting you the highlights of the last quarter and the first half of FY19. H1 FY19 key highlights. Our total income include net revenue and other income stood at rupees 508.2 crores as against rupees 545.3 crores in the same period of last fiscal. The volumes sold stood at 7,368 metric tons when compared to 7,598 metric tons in H1 FY18. The average realization was rupees 690 per kg versus rupees 718.
Excuse me, sir, this is the operator. Sir, the audio from your line is not clear. Can you speak a little far away from the mic?
Okay. The average realization was rupees 690 per kg versus rupees 718 per kg in H1 FY18. At the EBITDA level, we reported rupees 70.6 crores as compared with rupees 68 crores in the same period of last fiscal, thereby recording a growth of 3.9% year-on-year. EBITDA margin rose to 13.9% in H1 FY19 versus 12.5% in H1 FY18. Profit after tax stood at rupees 41.1 crores as compared with rupees 38.7 crores in the same period of last fiscal, recording a growth of 6.2% year-on-year. PAT margin improved by 100 bps year-on-year to 8.1% in H1 FY19 versus 7.1% in H1 FY18. Now coming to Q2 FY19 key highlights. Our total income, including net revenue and other income, stood at rupees 264.2 crores as against rupees 292.2 crores in the same period of last fiscal. The volume sold stood at 3688 MT when compared to 3941 MT in Q2 FY18. The average realization was rupees 716 per kg versus rupees 741 per kg in Q2 FY18. At the EBITDA level, we reported rupees 33.6 crores as compared with rupees 37.9 crores in the same period of last fiscal. EBITDA margin remained largely stable at 12.7% in Q2 FY19 versus 13% in Q2 FY18. Profit after tax stood at rupees 19.8 crores as compared with rupees 22 crores in the same period of last fiscal. PAT margin was maintained at 7.5% year-on-year. Going forward, we expect demand to improve and our capacities to continue to be optimally utilized. We continually strive to reduce our costs through backward integration and enhance our product offering to customers via value addition, thereby improving profitability of the business. This is all from our side. I would now request the moderator to open the call for question and answer. Thank you.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is on the line of Nitin Gosar from Invesco Mutual Fund. Please go ahead.
Hi, Chaudhary. Question pertaining to the sector. You made some comment regarding to the demand environment, and this was more to do with the festive season. Did I get it right?
No. Yes. Yeah. Sorry. Sorry. Please. Can you repeat the question?
This was the question. I think I heard it whether demand was muted in the international market, especially US.
Yeah, I said the demand was muted for the incremental sales, festive sales, which were supposed to happen, didn't happen, and they were mostly being taken care by the existing inventories which are already piled up at the warehouses of the destination, at the foreign locations. That's primarily in the US, because the inventories were already more out there than what the market could absorb at that point of time, or for the price level at which they are stored at. So because of that was the main reason where, of course, the sales had reduced marginally. And also, of course, I also mentioned that the certain sizes were not available. So, yeah.
And what would be the estimate in terms of inventory in the end market? Whether the inventories are high, low, medium?
Well, to be precise, we wouldn't be able to get a number precisely of the inventories. It's more of, the requirements of the market being taken care more by the product which is already available at the overseas locations than a new requirement arising for the finished product from the origin. You understand what I'm saying? So naturally the demand at that point of time was already being catered by the inventories which were present at the destinations. So that means there was more product at the destination than what could have been absorbed, or there was more product at a certain price level which could be absorbed. That's the reason it took time, and the customers, of course, were basically buying only on need-to basis, to be precise. So they were buying only those products which were not part of their inventories, all the customers in general.
Okay. And what would be the reason for staff costs to be high on a first half basis? I see first half staff cost is first half, that is for the first 2 quarters, the staff cost is somewhere close to 24 crores versus last year of 17 crores. What could be the reason for this jump?
The most important point is, of course, apart from adding more hatcheries and farms, which we have done so far, apart from that, there were quite a part of employees or workers who are working on casual labor basis, or rather on a daily basis. So we were actually, in order to bring them onto the roles, in fact, because we needed more people who are there, who are working consistently, because you would want to have a lesser turnaround of the manpower, or it's not staff, it's mostly pertaining to workers, to be precise, because most of the staff are all very much part of the team. It's the workers who are working on casual labor basis, or rather on they wouldn't be guaranteed, or rather who wouldn't be assuredly coming for work, have been more put on the roles, and that's the reason. To be precise, earlier they were in the other, it was part of the other expenses. They were the ones who had got transferred into the employee, and that's the reason employee benefit it looks like the manpower expenditure has increased. It's actually more of a transfer of from the other expenses, from the manufacturing expenses to employee related expenses.
Okay. And last question is on the facility. Once the new facility comes up, probably we may do a trial commissioning by Jan or maybe Feb. Should we be seeing full year the facility to be available for commercial production?
Yeah, as I mentioned in my opening day, for FY20, it will be fully available, because once the facility is ready, and even though we start the trial production, there are quite a number of certifications and audits which have to be completed. So we are very much sure that we will be able to keep everything ready, whatever, even if there are some of the audits not being completed in a short duration of time. By the end of March, hopefully we'll be completing, and meanwhile we'll start, for example, the first initial business once it is up and running in the third quarter, sometime in February, by middle of February, late in Feb. So we can even start doing for non-US markets, for example. And as the audits and certifications get over, That's the reason I mentioned it will be fully available for the financial year 1920. That was the reason I mentioned it in my opening remarks.
Okay, and the very first year the facility should be doing what kind of utilization?
We are looking at around 70% utilization, mostly because we are going to look at a phased-wise transfer of utilization from our leased facilities also as of now. So already immediately 6,000 metric tons will immediately be utilized, and the ready-to-eat products also, for which the customers are already started working with our QA team on the specifications, so that once we start the operations, we'll be able to start executing those orders and working more on those programs. So that way it should be an optimum utilization of 70% for the first year is what we are looking at.
What's the guidance we should be going by on the revenue front for FY20?
I think I also mentioned
1,400.
That was 1,400 was what we had expected. But of course, as you also see, the unit prices, for example, current year have rectified. It had corrected. If you notice, compared to last 4-5 years, the unit prices have corrected. So more of the value-added products, since we are going to do the cooked products, which I explained in the past calls also. So more of ready-to-eat products also should aid that to be in that to achieve such a figure, such a number, but subject to even the exchange rate fluctuations and the market conditions. We will be more realistic, to be precise, by the end of this financial year. I'm more confident maybe in the next call, or also for sure by the end of this financial year we'll be able to give a more realistic picture. This is what because we already gave a guidance of similar number in the past, so I just repeated. But that's the reason I reminded everybody on the opening remarks that it will be more realistic towards the end of the financial year.
Okay, sorry. Just mathematically putting, right now we are doing realization somewhere between 670 to 700 rupees. And keeping in mind the kind of utilization we may end up seeing in the very first year, we should be easily overshooting 1,500-1,600 crore, right? Or is there some concern which has been built in, and that's why the guidance of 1,400?
Yeah, there will be also, because it is not going, even though 70% of the new one is being envisaged to be utilized. Mm-hmm. The transfer of manpower, transfer of staff, and one of the key part is also getting the audits done, because some of the audits of the new facility are also not done when we need or when we want. So some of them do take time. So in case some of the customers are not going to accept the products immediately or right in the first quarter or second quarter, it may rather the audits, those customers' audits will get completed in the second half of the year. That is the reason, considering those concerns, that we may not be able to do everything, or rather achieve all the value correctly. That's the reason we have given this number. That was the idea. Yeah.
Got it. Right, sir. Thank you.
Yeah. Thank you.
Thank you. The next question is from the line of Vincent Andrew from Geogist Financial. Please go ahead.
Hi. Hi. Thanks for the opportunity. I have a couple of questions. I shall ask. I limit to 2-3 questions now, and I will come in the queue. The first one is on the volume side. As per the industry data, U.S. imports from India has grown by around 14% in the quarter.
Mm-hmm.
But we see our volume growth was degrowth only. Means any market share loss in U.S. we are facing?
We have not had any loss in the market share, but the most important point is we have also been having certain sizes which were not available. In fact, the order book which was full, kind of filled up with orders of pertaining from the Q1 are still to be executed in Q3 as on date as we speak, because some of the sizes were difficult which the company has taken up in the best interest of the company, as I mentioned, more on the pricing as well as profitability. So those sizes which were not available, and in order to the company not to just buy those sizes on a at a much higher prices, or rather reducing its profitability, the company has decided to work with the customers to rather postpone those orders and execute them at a subsequent stage, as we speak currently in the present day, so that we can, as the availability of supply is much more presently, that is helping those orders to get completed. So it's not really a loss of market share, but more of volume drop, mostly, as I said, because overall sales for our customers whom we have been working with in the US, they already have had inventories, and certain sizes which we were working also were of course smaller sizes which were having an impact on the production. The most important point, availability of certain sizes was very less, which made us to take a call to postpone those orders to subsequent dates. So these are the reasons. And in general, like you are mentioning about the increase in the volume to the US, which is imports. The imports what you are referring to in Q1 and Q2 are more pertaining to the volumes which have been exported in Q4 and Q1 of the current year and Q4 of last financial year. So the import data is also almost like a 30-45 days. It's an indication of 30-45 days lag period from the export to the import. Some of them are 60 days. So yeah.
So subsequent quarters, we can expect we will make up the volume in the subsequent quarters.
Yeah, we are definitely expecting the volume to be made up in the subsequent quarters, as we also have pending orders, and we are working with our customers, as I had mentioned in my opening remarks, that on both the retail and the food service segments, a lot of promotions are being done to encourage and rather to motivate consumers to eat more shrimp, providing the value of shrimp products. Simultaneously, we are also working on newer products with our customers, offering so that we can show a difference in value. Newer products, both in ready to cook currently, in the raw category also, which we are working currently. So those steps will definitely take care of increasing and maintaining the volume as such, similar to on par with what has been there last year.
Sir, it's okay. Then my second question is regarding the receivables. Actually, receivables have increased by around a significant amount, by 38 crore to 106 crore. And also the short-term borrowings also increased by 27 crore. Any particular reason for this sharp increase? Any credit period has increased normally?
The receivables have been not 1 minute, please. Can you repeat the question?
Receivables. The receivables have increased by around 38 crore to 106 crore in this quarter, and I think correspondingly the short-term borrowings also increased by 27 crore. So, any particular reason for this?
No, actually the receivables, of course, as you know, it is also got to do with the markets which we are working with. Since you know that we have also increased our market share in Europe, from 18% of last year to 25%, and we are still continuing to do that as we speak. The terms of payment with those countries, with European markets primarily, is on a much higher, at a more number of days when compared to the number of days in the US. But we are working with our customers so that we can minimize those.
So in US it is more than 30 days, 30 to 33 days.
In US it will be around 30 to 40 days max, 30 to 40 days. But we have customers with whom we are working in US who will also pay us upon invoicing, basically upon email of invoices. So in Europe, we are working on the payment terms with our customers too.
Okay, so it is basically because of the days terms in terms of increase in days with Europe.
Yeah, the increase in sales in Europe has an impact on the receivables because the the European payments are mostly stretched to 45 days, 60 days actually.
Okay, so should we, can we assume the same receivable days in the subsequent quarter or by the end of the year, 30 to 40 days? Now it is around the 30 days last year.
It will be maintained around this 30 to 40 days, but as I mentioned, we are also simultaneously working with our customers to improvise on the payment terms. And like I mentioned, with regard to our US customers, we get paid upon invoicing. Same way, we are also working with some of our European customers. We are confident that we will be maintaining it at 30-35 days. So but most of our data will be there on that part.
Sir, my next question is regarding to raw material. Can you give the raw material shrimp purchase price and the in-house cost separately for the quarter, if possible, with the quantity also?
I will get back to you on those details. Just give me some time.
Okay,
I will get back to you.
I will come offline also, no issue. I will come in the queue now. Thank you.
Okay.
Before we take the next question, we would like to remind participants that you may press star and want to ask a question. The next question is from the line of Mansi Nene, an individual investor. Please go ahead.
Hi, this is Mansi. Can you hear me? Hello?
Mansi, can you speak up?
Hello?
Yes, please.
Yeah, can you hear me?
Yes, Ms. Mansi.
Yeah. This is regarding what will happen to the lease facility once you start with your new facility.
As of now, we haven't yet finally decided whether we are going to completely exit them. But our idea is that we will transfer all the operations and business to our own facility. And since it doesn't happen overnight, it will be transferred in phases. Because we need to bring the new facility into order, and as it comes into order, we will be moving all our operations into the new facility. However, it's more of the final decision will be dependent on the market scenario, our order book, and the demand growth and demand in FY20, where we may opt to keep one facility even if at a lower capacity to take care of such a demand. That we'll have more clarity of that by the end of this year, by the end of the financial year, because that's when we'll have the better idea of both supply as well as demand scenario and how our order book will be placed.
Yeah. And one more question. Are we planning to export to new countries like South Korea?
Yes, we do have inquiries already coming in from South Korea as well as China, which we will be opening up more because our current capacities were mostly being absorbed by two major markets. Once the new capacity is available for us, it also not only gives us the ability to diversify into products, but also diversify into other markets like South Korea and China, which is China is the major market right now for Indian shrimp products, which is almost taking up 30% of India's exports. So we are focusing on those markets too, but we'll be mostly focused on into those markets to supply value-added products, whether it is in the raw form or the cooked or ready-to-eat or ready-to-cook, but not base commodity products.
Yeah. One more question. You are just talking about the unavailability of the certain sizes. Do you think that will be the same thing during Q3, or you will be able to get those sizes to export to US? You are already getting. Thank you. Thank you.
That's why. Yeah. Thank you.
Yeah. Thank you. Yes.
Thank you. The next question is on the line of Dipesh Kasha from Equirus Securities. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. Sir, can you, to start with, can you please give me the export incentive number for the quarter, please?
Yeah, the export incentive number for the quarter was 17 crores net.
Okay, 17 crores. Okay. And so, if I look at the quarter-on-quarter, the P&L statement, the cost of goods increased by 17% quarter-on-quarter, but your other expenses have reduced by 6%. So can you please give some color on these two line items and how should we think about it going forward?
In the case of raw material expenses, it has come down. That's what. So the cost of goods has come down because, of course, also that's also got to do with the volume, but also the sizes which we were handling, the smaller sizes.
So the quarter-on-quarter, the cost of goods have actually increased. So I think that is maybe linked to the farm gate prices, if I'm correct.
No, sorry. The overall, you mean between the first quarter and
the second quarter, yes.
Second quarter of this year
and the first quarter of this year.
Yeah, and the first quarter of but also the volume has increased more in the second quarter, right? So that is when you compare it to the first quarter, the second quarter's volume is higher, right?
The volume was, in the first quarter it was 3680 tons and in second quarter is 3688 tons, right? So it is almost similar. But your cost of goods have actually increased by around 17% quarter-on-quarter. So is it linked to your farm gate prices that have increased sharply in the second quarter?
They haven't, yes. Of course, one of the major reasons, of course, is the farm gate pricing, but also the sizes.
Okay.
Typically, the first quarter of the financial year will be dominated with small-sized harvests. Typically, unless they have been stocked early. So in our case, in our company's case, first in this financial year, the first quarter was, of course, having mostly the smaller sizes. That is one point added to the volume. But then the other point is, of course, the value. The farm gate price also has stabilized. It has improved, which is one of the major reasons for the farmers to gain confidence to stocking back their ponds again for the winter crop. And of course, they are making their decisions right now and the next month for their first crop of calendar year 19. Yeah.
Right. And the other expenses in the first quarter, you spoke about that the increase in logistic cost because like you are not able to find the raw material in the Andhra Pradesh itself and you have to go to other states, something like that. So now that have actually come off a little bit. So what is the guidance going forward of the other expenses?
The other expenses will, of course, would be maintained around this level, but it is also dependent on the sizes availability in the state of Andhra Pradesh. Of course, this year we had focused more outside Andhra Pradesh. We had been sourcing volume on par within the state of Andhra Pradesh. We have also been sourcing the equal amount of volume from outside Andhra Pradesh, which we will be again continuing to do in the first crop of next year. Currently, in this second crop of 2018, we anticipate good volumes coming in within the state of Andhra Pradesh itself. So our expenses pertaining to transportation for logistics cost should be coming down in this year and the in the last quarter. That's what, based on the volume availability which is there currently in the state of Andhra Pradesh.
Sure, sir. So lastly, next year you've given the revenue guidance, but in terms of the margins, like with your new value-added facility coming and also the processing charges are expected to reduce when you, which you pay to Royal Marine. So can we expect around 150-200 basis margin improvement next year?
I wouldn't want to give you, of course, based on the ready-to-eat, more of the ready-to-eat and products which are going to be there. Definitely, we expect an improvement in margins next year for sure, because ready-to-eat would be there. But the main thing is it will be the EBITDA per kg will definitely be maintained or improved for sure. Because of the ready-to-eat, it will definitely be we are looking forward to improve it further.
So how much capacity utilization looking for ready-to-eat category? That is the 5,000 tons.
Almost 90 to 100%, to be precise. FY20.
90 to 100%. And this year you're almost, I think you're going to pay around 18 crores to Royal Marine, right? So if that will go off next year, so definitely the margins shall go
yes, there are, as I told in my opening remarks, so we'll have much better clarity more towards the end of the year, because there are multiple things. Savings on costs paid to lease facility, additional realization from ready-to-eat products, savings on taxation part from the new facility based on the government policy which is applicable. So there are multiple factors which I'm sure we'll be able to give a more realistic guidance towards the end of the year.
Sure. So lastly, your revenue guidance of 1,400 crores, that excludes the incentive part or that includes the incentive part?
That will be actually including.
So this quarter your export incentive has reduced to around 7% of sales. So is it what going forward it will be the case, or it should be around 8.5%?
There is actually, this is 7 to 8%, but as you know, part of the incentive is also it's also got to do with the premium and the MEIS license script sales which are there. So that is one point. And but with regard to the anti-dumping duty, which is fixed, it's not going to be changing for now. So we'll maintain around this same level for the next 2-3 quarters also. 2 quarters at least.
Yeah. Great, sir. All the best.
Thank you. The next question is from the line of Gaurav Arora from Arora Investments. Please go ahead.
Yeah, thank you for the opportunity. Sir, I just want to ask one question related to the current season and what sizes are we looking for?
The current season, right now, the arrivals have started improving. As I had just mentioned to one of the earlier participants on the call, after the prices improving and stabilizing, many producers, farmers have started stocking, and thereby the improvement of supply has begun. And the sizes are typically the 40 count, which was not that available around 2 months ago. Now is started picking up, and we are looking forward for a continuous supply of that size of 40 count primarily and 30 count, because there were some issues with those sizes, which will be available, we believe so, because now the prices for those sizes are attractive for the farmers also to grow. And I think that's how they have also evolved their strategy for stocking in their ponds.
And so do we see any improvement in the realization next 2 quarters for the year?
We would not significantly see improvement in the realization. First point is on the unit value, dollar terms, of course, based on our increase in volume and value added, that is in the ready to cook segment, value added products, definitely that marginal whatever increase will be there, that will anyway be there. But we also have to keep track with regard to the realization in rupee. we have to keep a track on where the rupee is also moving. For example, as we speak, it is marginally slightly appreciating on a day-to-day basis when we compare it to the depreciation which had happened around 45-60 days back. So we do not see a significant increase in the realization to be increasing further for the current year, in the present context of ready-to-cook products which we are exporting.
Okay. So last participant who mentioned that the anti-dumping duty structure will remain the same. So can you elaborate on this same thing?
The anti-dumping duty till August, around July, August of 2019, we will continue to be paying in the United States an anti-dumping duty of 1.35%. That will continue to be the same. That's what I was telling him because there is no review on our company for the present year. So that's the reason we will have the same. Actually, I'm sorry. I need to correct my sentence. We will be paying 1.35% up till July 2020, not in 2019. That was a mistake. It is up till July 2020. We'll be paying that 1.35% only with regard to anti-dumping duty. However, our sales to the European Union and other markets are also going to increase as we work. So in the increased volume, naturally the products which are sold to Europe and other markets are not subject to anti-dumping duties or any duties, tariffs on our account. So I believe the more we increase in that, the impact of the anti-dumping duty payment could be minimized a little bit based on our volumes being done to those markets.
So one last question, there was one news article stating that the export to China via Vietnam has been impacted due to some restriction from the Chinese people. So would there be any impact on the Indian markets from that front?
Actually, it is in one way it was good that that for the Indian market it is good because Vietnam earlier the products going to China were being routed through Vietnam through their Haiphong port because the products being entered through Vietnam were duty free. Now the Chinese importers are visiting India. They are buying directly out of India, and in fact, India had started exporting directly to China. So very soon, hopefully in the next 6 to 9 months, we should see that the exports to Southeast Asia from India in general, even though our company doesn't do any, but exports to Southeast Asia will be coming down, that is Vietnam, Thailand, and it will be increasing significantly to China. We believe because now the Chinese are allowing the imports directly from India, even though there are some tariffs out there. But I'm pretty sure that is only it is only in the interest of the Indian industry.
Okay. Thank you, sir. We'll join you now.
Yeah, thank you.
Thank you. Before we take the next question, we would like to remind participants that you may press star and want to ask a question. The next question is from the line of Manish Poddar from Reliance AIF. Please go ahead.
I just had one question. I understand you were saying that you will revise your guidance by the end of year for FY20 of this 1400 odd crore revenue. And you are also alluding that, your realization per kg will improve because the mix of the product will improve.
Yes.
So, the volumes which you're saying 70% utilization for the new facility, even if I assume, a 50% utilization, you miss your estimate by some estimate, the revenue is significantly higher than your given guidance. So is there any other, are you factoring any currency or any other, factor which probably we're missing?
Of course, I explained that to one of the previous participants too. One is, of course, currency is one point, but I have also explained that the entire production, the entire capacity, even though we are envisaging to be utilizing at 70% optimum, but we also would have constraints. The products which we are gearing up to do, or the markets which we are gearing. Some of the customers will not be able to take the products from us right away because we started the facility and we are running. So there are audits to be completed. So during that period, we do see that there will be an issue with regard to which clientele base we can sell to. First point. Second point, of course, we would also have some like maintenance and related issues pertaining to our existing facility also. So that's the reason we have actually given a more of a conservative number. So we will be more realistic, as I said, by the end of this year, because we will have more clarity on the demand and also how our customers are going to accept the new facility when the audits get completed, the certifications get completed. And naturally, we can look at a better, volume growth and as well as the revenue growth. But I'm also we also factored in the concern of the existing facility also consolidating its operations a little bit because of we'll be taking up some maintenance works. So that's the reason. So of course, currency is still a major part. We cannot ignore that. Definitely, if currency is at 75 plus, it has its own impact, and if it is at 65, 66, it has its relative impact. So, yeah.
Okay, so that's really helpful. Just one more small thing, if I may. Let's say this 45 days of this, this period of post results, has your realization per kg is still in this, still declining by about 4 to 5%, or has that materially changed?
The realization per kg will be stabilized. Actually, in the third quarter, which I can't really talk about much, but the prices have stabilized. The prices have significantly corrected during the last quarter and the first quarter of this financial year, and they have increased, and now they are actually stabilizing. So we expect the realization to be more to be precise, on a flattish, not significant drop and not significant improvement, because now we are looking forward for some bigger sizes which also have a higher value to be realized. That helps in having a better realization overall, even though we would have all other sizes also and the smaller size products. And also some, now we are also prepping ourselves to enter into the markets like China and South Korea, which I explained to one of the other participants. So those because of the lower realization, lower unit value out there, combined with larger value, unit value realization from the Western countries, we will pretty much maintain the same. We believe we're going to maintain the same. Currently it is the same. It's around the same level. There's no significant rise, nor there was a marginal rise, but that's kind of stabilized now. So it's going to be around the same level.
Good. Thank you.
Thank you. The next question is on the line of Nitin Goswar from Invesco Mutual Fund. Please go ahead.
Hi sir. Did you mention that we are going to take some kind of maintenance activity in our existing plant?
Yeah, that will be looked at once the whole new facility comes into utilization. Then we would be planning up. But it's not a major. That's the reason. There are multiple reasons. We haven't yet planned it up currently, because we cannot start any of such activity or any sort of rectifications until we have the entire facility up and running, fully available with us. So that's the reason I was stating that is one of the reasons where, even though we have 70% utilization in the new facility, but there could be some marginal correction in the existing facility, which will have an impact. So I was giving the basis on which I was trying to explain on how the number has been given, because either you or the other participant were more looking at based on the utilization of the new facility, you were expecting a higher revenue number. That's the reason I was giving that reasoning for that.
Okay. And typically typically how long this maintenance activity go?
It takes approximately around 30 to 45 days. That's when we actually decide to do. That is, we would not be doing anything immediately. We don't have any plans. But once we have everything up and running, but again, that's why it's too premature to say at this point, because if any interruption happens, that's why we haven't given a complete guidance with regard to exiting out of any leased arrangement we have completely. The reason is that also. So now you understood why there are multiple reasons. So one is market demand. Then the other thing is the maintenance schedule, which will be required which may still require a capacity to be available. So we may still maintain some of the leased arrangement. So that will be decided at the right time, much prior, so that we don't hamper our business activity or business growth in general.
And typically you would also be taking into account which are the lean period which you want to take into factor and go for the maintenance activity, right?
True. Exactly. That's why it's nothing has been, but definitely on a whole year when you see, there will be some impact, but that will be mitigated by taking the necessary measures.
And once the new facility comes up, what's the overall operating cost we are looking at? And, I mean, vis-a-vis the existing facility, what's the add-on overall cost structures that we are looking at? Maybe employee costs which are fixed in nature, other operating costs which are fixed in nature, leaving apart raw material part.
Ladies and gentlemen, the line for the speaker seems to have got disconnected. Please stay connected while we reconnect the speaker. Ladies and gentlemen, thank you for patiently holding. We now have the line for the speaker reconnected. Over to you, sir.
Yes, sir. So the question
sorry
was...
about that.
No problem, sir. Yeah. The question was more pertaining to, currently we are running a 15,000 capacity plant, both ours as well as the leased one. Yeah. And the kind of cost we are looking at, fixed cost which I am referring to, that is the staff cost as well as the other expenditure which we generally report on quarterly statement. Both put together works out to be around 180-190 crore for FY18. Do we see similar kind of number getting added up because of the new facility which comes up, or is it the incremental cost going to be lower than the existing cost?
Incremental cost there will be an incremental cost, of course, right? But it's not that it's not going to be doubled. Okay, it's not going to be doubled. So, for example, some of the team members who are required for the new project, the new facility, are already with us. So, like those things, people are getting trained up, and the team is getting formed. So so it's not that the entire costs will be doubled. Of course, certain expenditure with regard to power and the electricity, those will be, of course, increasing pro rata to the volumes which are going to be done. So I don't see the cost to be doubling in any manner. It will be increased pro rata to with regard to the volume being done.
Got it. It's more of a variable cost now we're talking.
Yeah, it's more of a variable cost. Yeah.
Okay. And so one final bit, if you could help us understand the realization and raw material trend over last 2 quarters, or maybe the one that you reported and as of today where it stands.
The realization for the last quarter, for the half year in dollar terms, it was $8.2 was the realization. No, you were asking in dollar terms, or sorry?
Whatever comforts you.
Yeah, that was, I think, that was $8.2 was the realization. And the other one, what you asked me? Sorry, raw material cost?
Raw material, yeah.
That was an average 340 rupees.
340 rupees.
Yeah.
And
I'll give you that number again. Let me.
Hello, Nitin.
Yeah. Yes.
Are you done with the question?
No, ma'am.
Yeah, Nitin, I'll get back to you on that again.
Okay.
Yeah.
Okay. And where does it stand as on today, sir?
The average raw material price?
Average raw material price and average...
Yeah, that is... It is 380, 390 rupees actually.
380, 390.
380,
and realization would be somewhere around 9? 8.2 would be...
No, 8.2, 8.3. Around that, 8.3. Yeah. Actually, the last quarter also is on the same level. That will be at the same level. Yeah.
Okay.
Yeah.
Got it. Thank you.
Thank you.
Thank you. The next question is from the line of Vincent Andrew from GeoG Finance. Please go ahead.
Thanks for the opportunity again. Sir, my question regard to the cost again. Like you mentioned, the last quarter the shrimp raw material price was around 340, and now
no,
it is.
Sorry, no, that was wrong. The raw material cost was 380. That was a mistake. Sorry.
380 last.
Yeah.
So okay. In I think 2 quarters before it was around as per industry data, it is showing around the 300 levels.
That depends on which sizes were used. Yes, that depends on.
40 count, I think 40 count. So
that
now
was 2 quarters ago. 2 quarters ago, 40 count was
in July it is showing in July 40 count.
Yeah.
The raw material price is around 288.
Actually, it had gone up. I think in July itself, it had gone up. But with regard to the cost, the 40 count currently is at 380. It had gone up almost to 430 rupees. It had come down now to 380. But that is where we have, that is the market scenario, but we have been buying also from different places other than the state of Andhra Pradesh, which I had explained in the past. So that brings down our cost of purchases also. But our average cost for all the for the raw material was around 330 rupees. Sorry, and own farming. I think that was the question which you put. The own farming cost which you asked was around 250 rupees. So that was the two major questions. Sorry, I think I have to correct even the previous participant who was asked about.
So in this quarter it was 330 direct purchase average cost for you, and for in-house it is 250. So now it has increased to 380 and 400 levels.
Don't get confused. When I'm saying average cost, it is a mix of several sizes, and it is a weighted average of the quantity which is used. So we were using smaller sizes then. So a 40 count of 380 today or a 40 count of 440 rupees 3 weeks ago is not the bearing for the entire raw material average cost for the company or the industry. Like you mentioned, in July you are saying 300 rupees or something. It was actually by July, in August it started picking up, it started rising. It went to a low of 260 rupees almost. So when we mention about raw material cost, it is an average of all the sizes based on the volume which we do. So if we use small sizes, we will be having a lower raw material cost. But if we do more of larger sizes, for example, if we do only 20 count, our average cost will be sitting at 500 rupees. You get the point. And of course, our realization also will be there in accordance to that. Naturally, it depends on the sizes what you produce and what you sell, right? So naturally, so based on that. So, but also same is the case with our own farming. So it's an average cost of 250 rupees is based on the volume and the sizes which were harvested.
Okay. So there is no need of concern on the margin impact because of, okay, it is average, it is 30 and 250. Understood. Thank you. And sir, for the one more point is there, like the demand supply in US, can we assume it will take some more time because the industry data for shrimp prices it is now stabilized but not bottomed yet. And when I checked the supply side from imports from China and Ecuador, it has been increasing for the last 2 months or 2 months from China and Ecuador also. So and from India it is around 14% in the quarter. So the supply side it is there, and demand now can we expect in the coming festive season? The demand supply mismatch will be better in December, or it will take some more time?
Of course, first thing, I did not really understand what you meant by the imports from China and Europe.
China. Sir, the US imports of shrimp from China and Ecuador, it has increased in the last 2 months by around 30% and 40% something. India has also improved from a degrowth in the previous 2 months to last 2 months. It was around 14%. So the supply is there continuously. It is increasing. The concern is like supply is increasing more. So, do you think in the coming festive season it will improve? The demand supply mismatch will improve?
Well, yes. First thing is, with regard to what you mentioned about increase from China to USA or Ecuador to USA, if you look at it, China doesn't hardly ships much volume when you compare to India. India is the largest. So, for example, Jan to September 2018, it was 175,000 metric tons. Vis-a-vis Jan to September 2017, it was 151,000 metric tons. So, which is, of course, like it is on similar lines to what you said, around 15-16% growth on a 9-month period, if you see. Whereas the nearest exporting nation after India is at 96,000 metric tons. So we are almost talking about India having almost a double of the nearest supplying nation to USA is Indonesia, the second biggest supplying nation, which is at 96,000 metric tons, while we are at 175,000 metric tons. So India has its presence well established in the US market. There is no doubt to that. It is just that there are certain products which they have been buying, like you mentioned China. They do buy certain products from China which are breaded and ready to eat products, which have not been taking off much well from India until now, but that is where India is going to look forward to. Mostly, I believe so. At least our company is looking into that going into the future, mostly ready to eat products. The other important point we have to also consider is, you are talking about statistics of the past, but you also have to consider that there is a 10% duty which started being levied on Chinese exports, seafood exports from China to the USA. And that's going to be changed to 25% from Jan 1st, 2019. So all these factors are also there. So as such, Indian supply to USA will be the major. As I had mentioned, in a 9-month period, it is 175,000 metric ton for the present year. That will be there, and India's products are the ones which are occupying the most amount of shelf space or plate space, whatever table space we can call in the United States, as far as that is concerned. And the demand supply there were some issues with regard to supply. Of course, there were some issues with regard to demand. That's where I had mentioned almost 2-3 times during this call that there were a good set of promotions which have been taken up by the end customers, both at retail as well as food service segments, so that there is more shrimp consumption to take care of the supply. So we believe this is the stable environment. We should expect the shrimp to be consumed more, which is the only way for the product to be absorbed in whatever form it is, ready to eat, ready to cook, big, small size, whatever it is, peeled or whole shrimp, whatever it is. So we are looking forward to that. Naturally, we do compete with other proteins, whether it is the poultry or the red meat, whatever it is. So right now the promotions are being done, and the same thing is happening in Europe also. And as far as our company is concerned, we are also diversifying into other markets. Like we increased by 7% from last year to Europe. We are looking forward to increase that further, not only into Europe but other countries also. So we may be looking at bringing down our US business to anywhere of around 70% or lower, while we distribute the balance 30% and odd to other markets across the globe. We will have a better understanding of that more in the last quarter of this financial year, because we'll also have our new facility and the capabilities in place so that we can access those kind of markets also.
Okay, sir. Thank you. Clear. Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Chaudhary for his closing comments.
Yeah. Thank you, everyone, for your participation. In case of any further query, you may get in touch with Stellar Investor Relations, or feel free to get in touch with us at ir@apexfrozenfoods.com. Thank you and have a good evening ahead. Thank you.
Thank you.
Please subscribe and press the bell icon to never miss another